Alright guys, so home prices just hit a new median high of $440,600 nationally, and mortgage rates are sitting at 6.6% with no clear path down anytime soon. Now, if you are concerned about it as much as I am, I ask that you stay with me all the way to the end of this video because I'm going to break down exactly why rates are stuck where they are, what has to happen for them to actually come down, and what all of this means if you're trying to buy, sell, or just figure out where the housing market is actually heading for the rest of 2026. Okay guys, so let's not waste any time and let's start with where prices are actually at right now, because there's a big gap between the headline numbers and what they actually mean. So guys, according to the popular home database Redfin, single-family home prices rose 0.3% in the month of June compared to just the month of May. And they are up 3% compared to June of last year. The National Association of Realtors, which covers all home types, puts the median existing home price at $440,600, which is up 1.8% year over year. Now, either way that you look at it, prices are not falling. They are not crashing. They are slowly and steadily grinding to even higher levels. And I've said this almost every year for 5 years. There's no housing market crash, and the data keeps backing that up every single quarter. Now, I know some of you have seen headlines recently saying foreclosure filings have surged to 21% this year, and I want to address that directly because that number sounds alarming until you look at the full picture. Yes, foreclosure filings are up 21%, but that is a large percentage jump from a very small base. The actual number of foreclosures in the first half of 2026 was 227,548. In the first half of 2010, during the actual housing crisis, that number was 1.65 million. And we are not even in the same universe as what real foreclosure crises look like. And guys, just for context, home prices didn't bottom out during the last crash until 2012, 2 full years after foreclosures peaked. So if you're waiting for a crash to time your purchase at rock bottom and everything plays out like it did last time, you could be waiting until 2031 or 2032. And trust me, I understand why people want lower prices. Affordability is genuinely terrible right now, but the data does not support a crash being right around the corner. The real reason home prices keep holding up despite terrible affordability is actually very simple. It's the supply. There are currently 1.56 million homes listed for sale nationally, and that number is only up 1.3% compared to 12 months ago. There are 4.6 months of supply on the market right now, exactly the same as it was just a year ago. Nothing has changed. For home prices to fall meaningfully, you need a flood of new inventory overwhelming buyer demand. And that flood, unfortunately, is simply not happening. New home construction starts have been essentially flat for 4 years and are actually down significantly from pandemic levels. And on top of that, about 350,000 homes in America are destroyed by fires every single year. And I'm not just talking wildfires, I'm talking about regular house fires, which quietly removes inventory that nobody talks about. The lock-in effect is making things worse too. Nearly 70% of existing homeowners have mortgage rates that are below 5%. They have zero incentive to sell their home and take on a new mortgage at 6.6%, which means that those homes that are staying off the market are staying off market indefinitely. And until something forces a massive wave of sellers, like job losses, foreclosures at a true crisis scale, or a dramatic change in interest rates, the supply picture is not going to change enough to move prices down in any meaningful way. Now guys, I just want to quickly say if this video is giving you any value so far, please show some love by smashing that like button, leaving a comment down below, and subscribing. Your support genuinely helps this channel grow, so please guys, show some love by smashing that like button, commenting down below, and subscribing. Alright, now let's move on to the next segment. Okay, so now let's quickly talk about mortgage rates, because this is where the most important and most misunderstood part of the housing market story lives right now. Guys, the 30-year fixed rate is currently at 6.6%, and to understand why it goes there and where it goes next, you need to understand one relationship. Mortgage rates follow the interest rate on 10-year Treasury notes almost step for step. Right now, the 10-year Treasury yield is sitting at 4.63%. And here's the simple logic behind that connection. You can lend money to the United States government by buying a Treasury note and earning 4.63% essentially guaranteed. Because if the government runs out of money, they just print more and pay you back. Now, why would any investor lend money to an individual home buyer at that same rate? The home buyer can default, the home value can fall, the risk is completely different. So mortgage rates carry a premium above Treasury yields to compensate for that extra risk. That premium is why the 30-year fixed rate sits about 2 percentage points above the 10-year yield. The reason rates spiked earlier this year is pretty straightforward too. The Iran war broke out, energy prices surged, inflation expectations jumped, and investors demanded higher interest rates to compensate for lending in a more inflationary environment. Then, when there was de-escalation, the rates briefly dipped. Then, unfortunately, the conflict picked it back up, inflation expectations rose again, and rates went back up with them. Guys, that pattern has been playing out in real time all year, and it explains almost every meaningful move in mortgage rates since just February of this year. So, here's the question that everyone wants answered. When do mortgage rates actually come down? And the honest answer is that depends almost entirely on two things. First, the Iran situation and what happens with the energy prices. If the war genuinely de-escalates, oil prices can come down, inflation expectations can cool, Treasury yields can ease, and mortgage rates follow them lower. And I would think probably between 6 to 6.25% in a relatively short period of time. The US just announced a pause in military escalation this past weekend, which is a positive signal, but we've seen these pauses before and they haven't always held. And the second thing that matters is what Kevin Warsh and the Federal Reserve do on monetary policy. If the Fed signals any path towards rate cuts, which right now seems unlikely given that inflation just came in at 4.2% just back in May, that would give Treasury yields room to fall and mortgage rates would follow. But with inflation running hot and the Fed holding rates steady, there's no clear catalyst from that direction either. The best case right now, if there are no major changes to war situation or monetary policy, is that mortgage rates stay range-bound between 6 and 7% for the foreseeable future. And that's where we've essentially been stuck for the past 4 years, and nothing has changed enough to break out of that range in either direction. Alright, so let's land on what this actually means for your decision making right now, guys, because this data is only useful if it helps you act on it. If you're a buyer, the most important thing I can tell you right now is stop waiting for a crash and start focusing on finding a good deal within today's market reality. Prices are not crashing, supply is not surging, and the moment rates do meaningfully come down, that demand is going to rush back in, and any affordability improvement from lower rates could offset by prices moving higher again. That's unfortunately the paradox of this market. So I would say, shop aggressively, negotiate hard, look at deals that maybe went through for a moment's notice and was almost going to go through escrow, but then you notice that seller put the house back on the market, which means that deal didn't go through with whoever that buyer was, and now that seller might be more in a rush to actually get rid of it, so you might be able to negotiate a lower price. And, of course, make sure that your monthly payment at today's rates fits your budget without stretching you too thin. On the opposite side, if you're a seller and you're serious about moving, price your home correctly from day one. The longer a home sits unsold, the more leverage that you lose. Buyers start to wonder what's wrong with your house, and your negotiating position gets weaker every week. The days of pricing high and waiting for multiple offers is largely over in most markets. So in my opinion, price it just a little bit lower than you probably would, and you might actually end up doing the opposite effect where more bids come in. And lastly, if you're a homeowner with a rate below 5%, protect that rate like it's an asset, because it absolutely is. The difference between your current payment and what a new mortgage rate at 6.6% would cost you on the same loan amount is likely hundreds of dollars a month, if not maybe even upwards of $1,000. That locked-in rate is one of the most valuable financial positions that you could be in right now. The single most important variable to watch going forward is the Iran situation and what it does to oil prices and inflation expectations, because that is the direct line from geopolitics to your mortgage rate. And with that being said, guys, I'll be tracking all of this information and posting videos about it right here on this YouTube channel to keep you guys up to date. So guys, I want to thank you for watching this video all the way through. Please subscribe so you don't miss the next update and other videos that I put every other day. And please drop a comment down below and tell me what market you're in and what you're seeing locally. Are you trying to buy? Are you trying to sell? What has your experience been like so we could share that experience with our community on this channel? Thank you guys for watching this video again, and I'll see you in the next video.